Gary Wagner, editor of thegoldforecast.com, returns to the show to comment on today's CPI release and the market reaction thereafter. All markets are down for the exception of Bitcoin, treasury yields, and the dollar. So gold's down about 0.6% as we speak. As of 4 p.m. Eastern time, the S&P 500 is down 1%. The Nasdaq's down about 80 basis points. And this happened because the CPI came in hotter than expected today, 3.5% on the year versus 3.4%, which was the consensus expectation, and it climbed from last month's 3.2%. And so what is going on with inflation? What is going on with the Fed? And what is going to happen to markets? This will be the theme of our discussion with Gary Wagner today. This episode is brought to you by Moomoo. Gary, welcome back to the show.
Thanks so much for having me. Great to be here.
Okay, so CME Fed Watch tool, significant decline in probability of a rate cut by the next meeting or even by June. And so now the market's getting worried, hence the stock market correction that we're seeing unfold as we speak today. Gary, what do you think is going to happen with the Fed? What will they do?
Well, first of all, no one knows, but I have some assumptions. The key right now is not only did we get the CPI out today, but also the Fed minutes from the last FOMC meeting. And when you put the two together, the main kind of common thread I saw with the minutes was that they said that they need more data. They are not convinced that inflation is in fact going down. And they wanted to know if the last month that they saw, or whatever data they had then, they might have had 2 months, if that was a blip, so to speak, or whether or not the beginning of a trend. And so this marks the third month where we're seeing consistently sticky inflation, certain sectors not going down, specifically energy and housing being the most troublesome. The last they told us, of course, was the SEP, the Summary of Economic Projections, which came out at the March FOMC meeting, and they were still looking at 3 rate cuts. Now, there's a lot of talk about delaying those rate cuts, and that's what I noticed with the CME's Fed Watch tool. It was looking at liftoff prior to today having a high likelihood of being June, and that's what I and other analysts were saying, because that's kind of what the Fed was alluding to. I think if anything has changed, it's going to be when they initiate their first rate cut. They might only do 2, but I don't see them not cutting rates this year. I don't see that as a distinct possibility.
Well, why not? I've heard from several economists that a rate cut may actually be a policy mistake, given that, according to these economists, the economy is doing fine, and so a rate cut is unnecessary. How would you respond?
Well, I think it's more necessary than many people think, and not just to the consumer and not just to businesses, but we've got staggering debt in the US, and no one knows how it's going to play out because it's never happened before. It's kind of like gold's pricing right now. It's in territory that's unknown. We've got $34 trillion of debt, and just to service the interest on that is unsustainable over time. So the Fed, I don't think that the political pressure that many people talk about because of the election year is what the Fed's thinking about. They're thinking about how is our government going to maintain its ability to make good on its debts. And so to do that and to relieve that pressure, you want to normalize rates as soon as possible over the next 3 years, but getting a piece of that this year. And I think that weighs heavily on Chairman Powell and other Fed members, more so than political ramifications.
Do you think the Fed will respond more to inflation or unemployment this year still, Gary?
Inflation, clear-cut inflation. We had a exceedingly strong jobs report. That's not going to send them off, because when you have employment that's rock solid, which it has been, and companies are operating on at least 7 or 8 out of 8 cylinders, the concern isn't so much jobs as much as it is inflation, because that's what the American consumer feels. That's what people feel in Canada and in Europe is inflation.
What is the danger to the economy once again if the Fed keeps the rates higher for longer?
Well, obviously, it could lead to a recession. I mean, things have, in terms of opinions, have changed so dramatically in one day because all the headlines were soft landing, soft landing. Powell, I'm not convinced yet, but it looks like we're on the way to a soft landing. Keeping rates elevated for too long could have a detrimental effect on the economy, and they don't want to crash the economy. What they want is a strong economy that can handle the elevated rates, maybe for longer, but they do want to let that pressure out and begin to normalize it over the next 3 years.
Before we continue with our discussion with Gary on inflation and his inflation outlook, here's a quick shout out from our sponsor, Moomoo. Now, what I like about Moomoo is that it's not just for trading. There's a suite of educational tools you can use as well to make yourself a better trader or investor. For example, if you're interested in learning about options, simply open Moomoo, click on options, and there you'll find the relevant courses. Moomoo provides a whole suite of study plans. It's step-by-step, simple, and user-friendly. User interface is very well received by its users. There's also a paper trading simulation that allows you to replicate the feel of real trading. So click on the link down below to learn more about Moomoo's features, as well as their cash sweep program that offers a yield on your deposited cash. Okay, so let's talk about inflation itself. Breaking down today's CPI report, it was mainly driven by higher costs for fuel, housing, food away from home or dining out, clothing, so some discretionary items as well. On the whole, Gary, are you surprised that these items continue to stay hot?
Energy, I'm not that surprised because we have a great amount of oil that comes out of the Middle East, and that goes through a challenged area right now, which is the Red Sea. So the fact that shipping costs, insurance costs to get energy from that area of the world to either Europe, we don't really import anything from that area, but Europe's very dependent on that and Russia. I'm not surprised to see that energy remains elevated in terms of costs. It's over what, 85 a barrel now?
So energy has been a big contributor. So if we take away these variables, Gary, core inflation, which is ultimately what the Fed is looking at, do you think that will still stabilize and come down towards the Fed's 2% target by, I would say, the end of the year or even next year, Gary? What's your expectation?
Well, I think we are on a trajectory that's much closer to 2 than it is to 9, which is where the Fed started in March of 2022. So there's been significant movement. It's this last couple of percentages seem to be more stubborn than the first 6 that they peeled off of inflationary pressures because it was a unique environment when inflation rose to those dramatic levels. I think that they're still on that road to 2%, although my kind of inside joke is 3% is the new 2%. I mean, why have they set it at 2%? To me, that is almost arbitrary, but nonetheless, it's what they're setting as their target. As long as they're on a trajectory where they see a pattern of inflation moving lower, I think that they will have the necessary data to do some rate cuts this year. Now, the question now is whether that will be 3 or 2, in my opinion.
We have to look at inflation from 2 perspectives. One, which is how it's going to impact the Fed's monetary policy, which is what we just discussed. But number 2, how it's going to impact gold and the rest of the market. So we'll talk about gold in extensive detail today. But broadly speaking, I'm looking at the TIPS ETF. The TIPS, as you know, the Treasury Inflation Protection Security, broadly measures inflation expectations. Now, the TIPS ETF has been coming down while inflation has been staying steadily around 3%, now 3.5%, and in fact ticked up. I wonder why there's a discrepancy between what the markets believe inflation will do versus what inflation has actually been doing. Do you have any idea?
I'm going to throw one out at you, but since it is energy that's been the most prevalent, let's say, thorn in the shoe of inflation in terms of being persistent, and since there's a unique challenge getting it through the Red Sea and shipping costs have gone up, that's the one thing that wasn't something that they could account for in their models. I mean, yes, we're going to have geopolitical uncertainty, but if you would have asked people a year ago, would various militant groups along the Red Sea, whether it's Yemen or other parts, start firing missiles at oil tankers, at U.S. Military complex in terms of shipping, and would they challenge those lanes? And it's important to the free world that those lanes are open for commerce. So I don't think that the models incorporated that. And because of that, it's a great unknown, because who can predict when a conflict will end and how it will end?
Sure. All right. Well, on that note, let's talk about gold. So huge moves in gold, lots to discuss today. Let's start by pulling up I guess, recent price chart. And I'll start by asking you why gold reacted the way that it did today. I mean, certainly the expectation that the Fed is going to keep rates higher for longer isn't, it's not great for gold, I would say, for interest rates being high. But then again, we're not anticipating the Fed to raise rates, right? And of course, inflation being up should, all else being equal, be good for gold. So I'm wondering why gold moved the way it did today, which is down.
Well, we're looking at a daily chart in candlestick format of gold futures, and I'll pull up the price change. So right now, gold is down about $21 or 0.9%. When we look at that and then we look at the dollar index, which is up over 8%, you can see that the move today we're witnessing in gold is not so much sellers actively taking gold prices lower as much as dollar strength converting to gold weakness, because there's 100% negative correlation. And so that's what we're seeing. What we can do in terms of technical analysis, because once you get to uncharted territory, new record high prices, there is very few formulas, very few studies that you can do to project where in fact it could top out at, because we typically look at tops or bottoms. We look at fib retracements because it had been higher, and now we're seeing how much is it retraced. So it's difficult to peg a top. Now, let's assume that this move that we're seeing today is actually the beginning of some kind of a correction. Let's assume that to be the fact. One, it could be a one and done. We've seen that, or we've seen, as we did here in March, it moved sideways after running from about 2018 up to this top at 2217. It went sideways and then broke out again. So we've got this large red candle, but then it went sideways. So we could get a one and done, we could get consolidation, or we could get a real correction, which to me wouldn't be the worst thing. I mean, to me, that's actually healthy. When you're parabolic up, the longer a market moves in a parabolic manner to the upside, typically the quicker it rises, the harder they fall, so to speak. So I'm looking at possibility, if there is a correction, that it would be shallow. And a shallow correction, you would look at the 23.6% fib retracement, and the retracement data set is from like 2020 up to yesterday's high, the all-time high, record high. So I would think we're trading at 51. We could see it softened by about $50. And that would give a lot of people the opportunity to either add to or enter, initiate positions. So that wouldn't be the worst thing. I don't see gold having a deep correction because of the other fundamental factors that are providing this backdrop for this historic move. And that predominantly is central bank buying, which has enticed large money to re-enter gold as a more significant part of their portfolio. And that's not going to erode very quickly. Central banks will continue to buy, and geopolitical tensions are continuing to be forefront. So only one pillar of the three legs that gold's been moving up on is having a little bit of rebalancing, let's say, because of a possibility of less rate cuts or elevated for longer, even with 3 rate cuts. So what I would look at would be for gold maybe to test back to just above 23 or just below it. A deep retracement would be about 22.45, and typically a deep retracement would be like a 61.8% at 2160. I just don't see gold softening that much with the environment we're in.
I just want to see how you react to one of our previous discussions. You were right about calling for a higher gold price in 2024. I know that it's exceeded your own expectations as well. So I'm going to
Yeah,
play a short clip of our discussion in November, and I want you to just react to what we
okay.
talked about then, and then maybe go over what went differently than what you expected. Take a listen.
But overall, I'm exceedingly bullish. I would look at any dip to be shallow and short term. I would look for 2000 to become support, major support at 1960. In terms of levels of resistance, it will have to challenge 2040. If it goes beyond, and that's a double top, goes beyond that, 2080, and then the all-time record high is touching $2,100 per ounce. So I would think that it should go through at least one, if not challenge two of those levels, meaning 2080, before traders step in to pull profits.
Okay, Gary. So you were right about the trajectory of gold, and you had called the areas of support and minor resistance. Of course, we've broken above that resistance. What would you say was something that you did not consider when making that statement way back in November? Because clearly gold has run up way beyond what we initially expected here.
Absolutely. And I feel like November, that's dated. Not so much, because if you recall from my 2024 outlook, I was looking for gold to move between 2250 and 2300 per ounce in December. And we've surpassed that. My top line was 23, it's at 2350. And that's futures. Even if you go to spot, it's not that much less, maybe 2340, 2335. So the target I had in mind doesn't surprise me. What surprised me is how quickly we got there. I was anticipating this would be second quarter. Before that would happen, that the Fed had already begun the cycle of rate cuts was what I was basing my assumption on partially. So 22 to 23 is what I called in December. In November, and here's the thing, if we look, I'm going to move our chart back so that we can see the action back then. We did have a rise from about 1900. We then topped out at about 2100, came back down, tested and held 2000. But right here, these candlesticks right here was an interesting weekend that we had. And that was the kind of action I was talking about when I made that comment back in November. Because if you recall, this is a Friday. And so gold opens at 2096. It closes at 2131. And then Monday in Australia, where the first trading goes on for the next week, the opening bid was 2134. But look at the high that came in. The high that came in was 2193, right up here. So you've got this large wick, and then not only does it close lower, but you get this engulfing bearish, which means that the real body of Monday's trading action fully engulfed what happened, the gains on Friday. And so you did get a sell-off, but it was tepid at best. I mean, we went from the all-time record highs then down to finding support at about 2020, 2030, right in that area. And so that was kind of my concern, is that when you get a market that goes parabolic, it has a tendency to have really increased sensitivity or volatility to any kind of change in
Yeah.
the economic outlook and things of that nature. And that's what I was addressing back in November. Look, I obviously I called for 2250 to 2300, and it went to 2385. If I'm going to be wrong, David, this is the way I want to be wrong. Underestimating it. So if the relevant question was, why didn't I predict that it would go to 2180 or 2385 is really the question. And why did I think it would take longer than it did? Basically because I was anticipating rate cuts in June, because that's what they were talking about back then. I was thinking that the Fed is going to try to stick to their mandate. We don't believe they're going to raise rates. They're going to keep them elevated for longer, but that's not moving back to tightening, except that they're in the minutes of the last FOMC meeting, they talked about tapering the buybacks of their balance sheet. So they are still tightening in that way. I'm glad I underestimated it, but I still believe that it had the potential to go between, let's just say, 22 and 2300. I thought it would take a lot longer throughout the year to get there, but it did get there. And that's, to me, I'd rather err on the side of it, me underestimating it, than say it's going to 22 and it's sitting at 1800.
Right.
But I did not greatly, but I did underestimate the power of the bull when it comes to gold recently. Yeah,
Okay.
no doubt.
Gary, I spoke with an oil analyst recently, and he said that in his opinion, the current price of about $85 a barrel is pricing in roughly $20 to $30 of geopolitical risk premium. And I want to
Okay.
ask you the same question as to whether or not gold is also factoring in a significant geopolitical risk premium by the order of perhaps even $200, which is what happened when Russia first invaded Ukraine 2 years ago.
Well, excellent point. First of all, it is factoring in a premium for upticks in geopolitical uncertainty, wars or conflicts on two major fronts, Middle East and Russia and Ukraine. And so that is baked into the price of gold. We can see what it did, for example, with the attack in Israel. If we go back to October, and we've got gold sitting around 1900 right here. And if you look at it by the beginning of December, and that's when you had that flash crash, so to speak, it moved substantially higher. So right there you had 2200, and from the beginning of the conflict, call it 1900. So you could surmise that a good portion of that $300 gain had to do with the political problems and the military action that was going on in the Middle East, undoubtedly. How much, that's a difficult thing to answer, but certainly there's premium in gold that is based upon geopolitical skirmishes, military action, or even just uncertainty.
What I'm concerned about, Gary, is whether or not this geopolitical risk premium is going to be short-lived, as it has been in the past, right? When, again, going back to the war in Ukraine, upon the initial invasion in February, gold went up, but it didn't stay up. And so usually what we've seen with these geopolitical risk premium is that they're short-lived. So
Right.
yeah.
We have to say, look at the data. I don't want to sound like the Fed, but if we look at the data, October it's sitting at 1900. Now it's sitting at 2351. The conflict in Israel is still fully going on, and Russia is at yet a new level of carnage when it comes to their attacks in Ukraine. I hate to be jaded in this way, but I think a lot has to do with the news cycle. The media, I think, has a huge impact on what people focus on. And when that goes out of the news cycle, the action is still just as bad. I would love to see gold go down 200 because peace was reached on two fronts. Are you kidding? But I don't see an end game that is quickly solvable in terms of the conflicts currently ongoing. And that's the issue I have. We have seen it rise and fall, but you can't say that in this instance when you consider just a few months ago, in October, it was at 1900.
So
And so now
ultimately,
it's, yeah.
yeah, okay.
So that would be my take.
Yeah, fair enough. So we've talked about the long-term fundamentals. Ultimately, then, for traders watching this right now, is now a good time to be taking some profits?
A futures trader should be tightening stops so that further softness in pricing will be able to lock in the profits that they have. For example, we pulled a trade where we got in on the second leg. We got long right in this area at 21.98. We moved our stops up and got stopped out when the market kind of tested and moved back down at around 2,300 right here. And so as a futures trader, I'm trying to get a percentage of the move. As a investor that is purchasing physical gold or silver, we want to use dips to add to our inventory. And that's what the central banks are doing. Right now, you've got a lot of momentum, and that doesn't seem to be diminishing. Personally, I haven't seen it yet.
All right. Exciting day for the markets. Thank you for breaking down this volatility for us, Gary. I appreciate it. Where can we follow your work and learn more about you and candlestick charting?
Thanks. I do write a daily article, commentary on Kitco, but my site on YouTube, The Gold Forecast, has got about 3,000 videos. So I try to work with not only current market scenarios, but to teach what I'm looking at and why I am. And those are free and available to anyone that wants to view it. The Gold Forecast on YouTube. And then, of course, our premium channel, which is our website, thegoldforecast.com.
Excellent. We'll put those links in the description down below. Make sure to follow Gary there. Thank you again for coming back. We'll speak again soon. Plenty of action to discuss over the coming weeks, I'm sure.
Thanks for having me.
Thank you for watching. Don't forget to like and subscribe.